You know the deal with a 401k, right? For most of us, it's built on a simple promise. Put your money in, let it track the market, and don't touch it for 30 years. It's supposed to be passive, diversified, and safe. You own a small piece of everything, and your wealth grows as the economy grows. But what if one single event could stress test that entire promise? What if the most anticipated stock market debut in history, the SpaceX IPO, is about to create a situation that could warp the very index funds your retirement relies on? This isn't just about another hot tech stock. It's about an event so massive that it has already forced a quiet conflict between the rule makers of the market. An event that could make your passive retirement fund place one of the most aggressive, concentrated bets in financial history, whether you want to or not. To get why this is such a big deal, we first need to appreciate the elegant system it threatens. At the heart of most 401ks are index funds. Think of an index like the S&P 500 or the NASDAQ 100 as a recipe for the market. That recipe lists the biggest, most important companies, and an index fund is just the chef that follows the recipe perfectly. If a company makes up 5% of the index's value, the fund puts 5% of its money into that company's stock. Your investment is automatically spread across all the ingredients in just the right proportions. This is the soul of passive investing. No one is in a back room making risky bets with your retirement savings. The fund just buys what the index recipe says to buy. If a new company gets big enough, it gets added. If another shrinks, it's out. It's automatic, it's passive, or at least it's supposed to be. For decades, this has worked beautifully, but the entire automated system was built before a company like SpaceX. Recent reports and filings suggest SpaceX is targeting an IPO valuation that could be around $1.75 trillion. This would make it one of the largest IPOs in history, potentially raising 3 times more than the previous record holder, Saudi Aramco. A company this huge, this hyped, and this unconventional is a massive stress test for the rules that have governed our portfolios for a generation. Here's where things get distorted. An index fund tracking a major benchmark is, by its own rules, obligated to reflect the market. When a company becomes that massive, it has to be included in the recipe. But what happens when you add an ingredient that big to the bowl? Suddenly, a big chunk of your diversified fund could be tied to one single, famously volatile company. Your retirement account's performance could become tethered to the launch schedule of Starship and the unpredictable nature of its founder. This is called concentration risk, and it's the exact opposite of what index funds are built to do. This unprecedented situation has sparked a fundamental disagreement among the companies that write the index recipes: S&P, NASDAQ, and FTSE Russell. We already saw a preview of this with Tesla's dramatic, delayed inclusion into the S&P 500, which caused huge debate and market ripples. The SpaceX IPO could amplify that divergence to a degree we've never seen. For the first time on this scale, the specific index your 401k fund tracks could lead to wildly different financial outcomes. It all comes down to a quiet battle over one simple question. What do you do when a whale this big is about to enter the pond? This is the point where your passive investment becomes surprisingly active. The disagreement is being fought over fast entry rules. On one side, you have index providers like NASDAQ and FTSE Russell. Recognizing that massive companies are staying private longer, they've modernized their rules. FTSE Russell can now add a massive IPO to its indexes after just 5 trading days, provided it meets certain criteria for size and float. NASDAQ has adopted a similar rule that can allow inclusion after 15 trading days for the largest new listings. They argue that an index's job is to represent the market as it is right now, and if a company of this size appears, it needs to be included quickly to be accurate. If your 401k holds a fund tracking a NASDAQ or Russell index, your fund may be mandated to buy billions of dollars of SpaceX stock just days after its debut, not based on fundamentals, but on a mechanical rule. On the other side of this divide is S&P Dow Jones, the keeper of the iconic S&P 500. They are the traditionalists. S&P has decided to stick to its existing rules and not create a special fast track for mega IPOs. Their methodology generally requires a company to have a track record of trading and, crucially, to have demonstrated profitability over 4 consecutive quarters. Based on what's known, it's not clear if SpaceX would meet that strict profitability requirement right at its debut. So, if your money is in an S&P 500 index fund, one of the most common investments in the world, you would be walled off. While other funds are forced to buy, you'd be watching from the sidelines for what could be a year or more. Let's just pause on that for a second. If your index fund is forced to buy billions of dollars of a speculative stock the moment it lists, are you still a passive investor, or have you just been made a venture capitalist without your permission? This sets up two parallel universes for retirement savers. One group will be immediately exposed to SpaceX for better or worse. They'll ride the wave of initial hype and the forced buying from other passive funds. The other group will be completely left out, missing any potential early gains but also shielded from the volatility or a post-IPO slump that has hit many big offerings in the past. For the first time on such a massive scale, the specific index your fund tracks isn't just a tiny detail. It could create dramatically different results. So what does this all mean for you? This isn't a video telling you to panic and sell your 401k. It's not financial advice. It's a heads up. The SpaceX IPO isn't just about one company. It's a test of the whole passive investing system. It pulls back the curtain to show a hidden truth. There are very active decisions being made that shape your supposedly passive funds. The world of investing is getting more concentrated. Mega-cap tech and AI companies are already tilting the market toward a handful of giants. A SpaceX IPO would be the exclamation point on that trend. The lesson here isn't that passive investing is broken. It's that you can no longer afford to be a passive observer of your passive investments. You need to know what's under the hood of your 401k. Is it an S&P 500 fund, a Russell 1000 fund, a NASDAQ 100 fund? Because that choice, a choice you might not have even known you made, could soon matter more than ever before. The game is changing. The line between passive and active is blurring, and now you know what to look for. If you want to stay ahead of the big shifts changing the markets and what they mean for your money, make sure you subscribe and click the bell for more analysis like this. Thanks for watching.